Business. And I go out and I visit a customer and I make the sale. And I come back to work and you say, what happened? And I say, I made the sale. That's a business term, not an accounting term. We have agreed to provide them with a series of services over a period of the next 6 months. They're going to pay us $100,000 a month for 6 months. As we speak, we are very happy, but there is no revenue and no profit yet. Revenue is recorded when we earn the money, and so far we haven't earned it. That entity could be another company. That entity could be a building, an office building if we rented it out. And we could figure out the value of that building as an owner, and then from that impute what rent we'd be willing to pay and not be an owner. Because I could take $50 million and buy the building, $10 million in equity, $40 million in debt, and buy the building and live, in theory, rent-free. Or I can take that $50 million and buy some more companies. So in measuring whether I'd like to buy that building, as an example, one of the opportunity costs is the alternative of buying a company or two. What kind of cash flow can I get by buying 2 companies for $25 million each versus the rent I'll save by buying that building for the same $50 million? There's the amortization of intangible assets, a lot of one-time expenses, and they have what they call operating income. There are 2 key ratios so far. One is the gross profit percentage, which is a measure of value added, and it's also a measure of efficiency. Operating margin is operating income of $8,949,000 $8,949,000 divided by 46,482, which is the total revenue. These are measures of value added, obviously measures of success. To the extent that Time Warner and AOL are fixed cost businesses, higher revenue should result in improved operating margin because they're just better using fixed cost. In a fixed cost business, and you can calculate when you get a chance all 3 years. In a fixed cost business, as many of their businesses are, higher revenue should result in much higher profit. So over the 3-year period, their operating margin should be getting higher, the percentage. Okay? Their interest expense, and you can see that below the operating margin are all of the costs of financing, all of the one-time charges. The operating margin is designed to be a measure of the regular, repetitive, everyday businesses. Resources in an organization, which is money and people, are not allocated to the best projects. Resources in an organization are dedicated usually to good projects, I'll throw that in there, by their sponsor. The better you connect what you would like to accomplish to the financial success of the business, the greater is the chance that your project will get the financial support it needs. Part two of that, whatever our backgrounds, we need to connect ourselves financially to our company's success. When we make that connection, part two of that statement, the more effectively we make this connection, the greater will be the profitability of our business, our contribution to that financial success, and as a result, our career achievement. I look at a company's financial statements. I'd like to know the gross book value, the accumulated, and the net book value, so that in general, I can get a sense of how old their equipment is. Why do I care about this? If I was competing against a company with mostly new equipment that had a lot of technological video equipment and pre-press and all kinds of other types of modern equipment, all kinds of modern computer equipment, I know that they're pretty up to date in what they're capable of doing. If I was competing against an ad agency or a publishing company or some other type of media company that had relatively old stuff, I know that in order to compete for certain business, they're going to have to spend a lot of money to buy what they're going to need that I already have. When I look at a company's balance sheet that's certified by a reputable CPA firm, got to throw in some adjectives here, and they say these financials are prepared in accordance with generally accepted accounting principles, I know and feel pretty comfortable that the assets are worth at least what they present them as on the balance sheet. They might be worth more, but that's up to me to decide, not the accountants. I have a measure called days sales outstanding. And I'll show you this calculation in just a second, especially for a private company. Think of everything your company does. You invest in machinery, you invest in web design, you invest in editorial, you invest in content, you invest in people, you hire the people, you train the people. All of the things you do require that you spend money, so that all of the things that you do, however exciting and fun and profitable, are all focused on one day. A little dramatic, but I believe it. And that one day is the day you get your check. Why do you care about this? The day you get the check, and the faster you get that check, the faster you can reinvest it and do it again.